Welcome to the Treasury Update Podcast, Coffee Break Sessions, presented by Strategic Treasurer, the show where we cover foundational topics and core Treasury issues in about the same amount of time it takes you to drink your cup of coffee. I'll be your host, Jonathan, Media Production Specialist here at Strategic Treasurer, so sit back, relax, and enjoy the show. I'm here with Craig Jeffrey for another episode of the Coffee Break Sessions. Normally this podcast goes over a definition, but today you're getting two definitions. So Craig, today we're going to talk about modeling and forecasting. What are those?
In Treasury, we think of those pretty similarly. I mean, forecasting is the projection of an activity or results, and that could be things like, weather, temperature, cash flow, defaults, demand. Modeling is the set of formulas or assumptions used to determine the output for a forecast. So there's a model that goes into making a forecast. And you might run multiple models, and your forecast may have a range or it may have a specific number. It may be the combination of multiple models, and then you arrive at what forecast you're going to depend upon. But one's a projection and one is how you do that projection. Sometimes they're used interchangeably, so you're not really getting two full definitions on this coffee break session, but you're at least getting some definitions and description in the same general realm.
Yeah, and that's why we put them together, because they're a pretty good pair. So how does this partnership of modeling and forecasting help treasurers with decision making?
The idea that forecasting certainly uses data and models, and these models can really speed the process up where people are depending on cash flows, for example. Maybe simple models might be we do a moving average or we just use a weighted average to see what we expect from a cash flow with the assumption that the past is a good indicator of the future, right? What occurred in the past is likely to be what occurs today. And you might do a weighted average, which says stuff that's happened more recently is more important than the past, but we want to look back over a period of time. And so if things are increasing or decreasing, if I weight more current numbers more heavily, I'll do better with my forecast. And that may be some level for helping. And there might be some other models that allow you to say, well, I can't just drive my car by looking in the rearview mirror, i.e. using different types of averaging models. I might find some precursors to those changes, some independent variables that feed into the dependent variable or my forecast. So if I see that the distribution, the number of stores I have, as I'm adding stores, and I figure out how long it takes for them to ramp up, the fact that I have new stores going in gives me an ability to forecast and project from that, because I have information about those independent variables and how that will in fact impact, let's say, my sales, my revenue, or my margin. Those are some of the things that we use to focus on a forecast. The other thing, John, I think is useful is, the difference between an expected value and a range. And I've talked about this on different podcasts, but sometimes people they come up with a forecast and it's like, I think it'll be $5.23216 million come in tomorrow. Well, that's very, very specific. And that may be nice. And why is it almost always different, or it's always off by a certain amount as well? Because there's a number of variables. So sometimes it's much more helpful to say, what's the expected range? I'm confident that 2 out of 3 times it's going to be, 4.5 million to 5.5 million. I'm 95% confident it's going to be 4 to 6 million. And having some information where I know a range tends to be more helpful. We tend not to put our forecasts together that way, most commonly in terms of the broader industry. But that tends to be more useful to say, here's the variability I expect.
So if you expect a range in the outcome from your forecast, do you put together a plan of range of action to match that?
Yeah, that can be defined if it triggers certain events. Now I need to borrow more, or I'll invest excess cash if I have it, and I'll leave a certain amount on the reserve side to hold it. Yeah, it's recognizing that this range can happen. What do I do at the top end or the low end of the range? Even with a pretty sizable confidence interval, it might be like, I'm 95% confident that cash flow will be between these two items. Well, let's say it's below the negative side. What do I do if it goes below the negative side? That might be 1 out of 20 is going to fall outside the overall distribution, and maybe 2.5% is going to occur on the negative side. That's an event that's going to happen every career. If that's a year-long event, if it's something that you're projecting on a weekly basis, that's something that's going to happen a couple times in a year. So once a career, once or twice a year is where you're going to see that. And how do you handle that?
So be ready for a negative outcome. Be ready to have an action plan.
Or you should have some, like, what would you do for that? How would you make adjustments? Let's say cash is very negative. What can you do? Do we have to sell other assets? Do we have a credit facility we can use? How can we slow up our disbursement? We can offer different kinds of discount terms so that our customers pay us early. Those are all some of the things that can be done.
What are some of the key types of data that treasury teams are going to use for this modeling and forecasting, and how does it contribute to the accuracy?
Yeah, that's a good question, and it's hard to answer in great detail for each of the items. I'll give you examples for it, but these are things to think about. There requires more specific application, but one of the biggest things that treasury groups use is historic bank information. Why? Well, it's readily available. They get all that information in. They've got history that shows the net cash flows and the detail flows that have occurred through their banking system. So that's used. That's probably one of the most common areas. Easy to get, and it's going to be accurate. The second tends to be sales and accounts receivable data. Sales gives an earlier projection. There's a contract that's been entered in, goods are sold, services are sold, and that's going to convert to accounts receivable, some kind of invoice, and it's going to get paid over time. And so sales a little farther out, receivables typically, might have 30 or 60-day terms, something like that, so that they can use that to manage inbound flows. The other things that are used might be curve data, so interest rate, future interest rates, items related to commodity pricing, the futures for commodity pricing, could even be things like weather, expectations about the economy. All of those things can factor into the models that people use. It could be projection of new home starts. If you're in a business that sells something that is triggered by new home starts, there's a range of things that can be used, but it starts with internal company data, usually from the bank, then extending throughout the financial systems of the company to external data, market data, other types of information. And so that all of that information, the more data you have, and if you have a good model, better data, more complete data, accurate models allow your forecast to become more accurate if you're doing things in the natural way.
Do you have a specific example of when a company excelled from their forecast, that they predicted something and their company really did well because of that? It can be a widely known story. It can be something that you saw in your career.
I'll go to a simple example that's not publicly known. I won't mention the company, but the company, they went through both the short-term cash forecasting as well as long-term balance sheet planning. They had all the plans for their capital needs, looking and tracking to make sure that they had capital to manage the business. But on the short-term forecasting side, they were experiencing volatility. It was really important for them to be pretty accurate. And so they kept working on improving their forecasting. And I remember talking with the person who had created models, and he had done a really good job of improving it, going through iterations. He had moved the process of trying to address the treasurer's concern, who was concerned about the volatility of the flows and some of these wide variances that they had. They had moved to looking at things from a day of the month scenario for cash flows that occurred. They even looked and broke things out by week of the month, right? So just, distribution, things like that. They moved to day of the week, within the week of the month, they moved to day of the week and started refining the model. They found by backward testing, they got that got better. And as we worked with them further, one of the other elements was, factoring in bank holidays and tracking that, because that blew up their model whenever there was a blank bank holiday, not because there was nothing that day, but because of what shifted later and what shifted earlier. Was the bank holiday on a Monday? Was it, on a Thursday, et cetera? And so, as they continued to refine and looked at different ways of distributing it, taking into account holidays, and these are all fairly simple. These are things you can do with Excel. You're not even doing regression. And that really isolated and made their forecasts extraordinarily accurate. They did pretty good, but there was still significant variability. But as they tightened up the last couple of areas, all of a sudden it's like, okay, now we got a forecast that falls well within our band of comfort, essentially all the time, as opposed to having something occur at least every other month that was fairly significant of a difference that got the treasurer excited. And so this, reduced the level of excitement. The team got much more comfortable with the activities. And so I think that goes to show just being able to focus on the forecast, figure out different models, and then find out what works the best can really make a difference for an organization.
What was the reward for that forecast?
Well, you could look at it a couple of ways. One is not having to answer to the treasurer, so there's a career and social reward. The second was their cost for borrowing same day was, I can't remember if it was like 1% higher than borrowing, the next day, having to borrow your funds at a later date. So since these were significant sums that they'd have to borrow at the last minute, borrowing 20, 25 million, there was a legitimate cost to that. So they looked at that from an economic standpoint. But I'll tell you, in that particular case, it was more not getting all the attention from senior management, not necessarily just the cost of the funds they had to borrow versus the alternatives.
Yeah, that's interesting. Thanks for sharing that. And thanks for being on this podcast today.
I was glad to talk about these items. Thanks for bringing up AI when we talked about data extraction as well. That made that one fun. And today, talking about modeling and forecasting brought back a lot of historical memories, as well as so many companies are looking at forecasting and trying to do better. And the use of tech and data extraction feeds into modeling and forecasting in some really good ways. Thanks, John.
Yeah, this was really fun. For our listeners, make sure you tune back every first and third Thursday of the month. And if you have any topics that you would like discussed on this show, send us an email. There's an email in the description. Have a good rest of your week.
This podcast is provided for informational purposes only, and statements made by Strategic Treasurer LLC on this podcast are not intended as legal, business, consulting, or tax advice. For more information, visit and bookmark strategictreasurer.com.